Major financial crises, like the one that kicked off the Great Depression, they don't just happen by accident. They aren't random bolts from the blue. They're patterns. They are cycles of boom and bust that repeat with this almost eerie predictability. Today, we're going to pull back the curtain on the ghost of 1929 and use it as a kind of blueprint to understand the powerful forces that are shaping our economy right now. Let's dig into the pattern.
In our guide for this, a guy who saw this pattern with just stunning clarity, Jesse Livermore. He was a legendary trader who famously made an absolute fortune. We're talking over $100 million by betting against the market right before it imploded in 1929. Now, he wasn't a prophet. He was a student of human behavior. He believed that greed and fear drive markets in these predictable ways. And his pretty cynical view really sets the stage for our entire explainer.
All right, so here's how we're going to break this down. First, we'll look at the setup, how these artificial booms get created in the first place. Then, we'll dive into the crash itself, not as some random accident, but as a massive transfer of wealth. After that, we'll explore the aftermath, where power and control gets super centralized. And finally, we'll ask the big question, are we seeing these exact same patterns play out today? Okay, let's start with the boom. The Roaring '20s. It wasn't just some spontaneous party that everybody joined. Like a lot of economic booms, including the one we've just lived through, it was, well, engineered. It was built on a foundation of easy money, all created by a pretty new and incredibly powerful institution. Now, this right here captures a huge shift in how the world works. For centuries, economies were built on, making actual stuff. But in 1913, just 16 years before the Great Crash, the United States set up the Federal Reserve, a central bank. And this new institution had the power to literally create money from debt. For the first time, money wasn't just tied to something real, like gold. It could be expanded and contracted by a committee. And that right there set the stage for an unprecedented explosion of credit. And here's exactly how that played out. Throughout the 1920s, the new Fed kept interest rates super low, just flooding the market with cheap money. This wasn't happening in a vacuum either. The head of the Fed was actively working with the head of the Bank of England, managing global credit together. And the result of all this? A decade-long speculative frenzy that pushed the stock market to just dizzying, totally unsustainable heights. Does any of that sound familiar? It should. Back in the 1920s, they called it easy credit. Today, we've got a fancier name for it, quantitative easing, or QE. The tools are a little more sophisticated, maybe, but the principle is identical. Back then, low rates fueled a stock bubble. Now, near zero rates have fueled bubbles in stocks, real estate, crypto, you name it. The point is, in both eras, the foundation was an artificial expansion of the money supply, driven by central banks. So, you have the setup, a massive bubble built on a mountain of cheap debt. Now for the main event. We're usually taught the crash was an accident, right? A market failure. But what if it wasn't an accident at all? What if it was a predictable, and for a select few, very profitable transfer of wealth? This is really the core of the argument. The crash didn't just happen, it was triggered. After years of flooding the system with easy money, the Federal Reserve suddenly and sharply raised interest rates. Credit just dried up almost overnight. For anyone who understood the pattern, this wasn't a surprise. It was a designed contraction, a way to purge the system and consolidate assets into stronger hands. And this illustrates the playbook perfectly. First, you inflate the bubble with easy money. Second, and this is the crucial part, those closest to the action, the insiders, they quietly get out near the top while the public is still piling in. Third, you pull the plug by tightening credit. And finally, you just sit back and watch as panic selling causes a total collapse, which lets you buy up all the wreckage for pennies on the dollar. It's a brutal but incredibly effective cycle. And listen, this isn't just a theory. Look at who was prepared. We already talked about Jesse Livermore, but there was also Bernard Baruch, a presidential advisor who sold everything before the crash. And then you had these huge international banking families like the Rothschilds, whose wealth was spread all over the world, allowing them to ride out the storm while thousands of smaller local players were completely wiped out. They didn't predict the future, they just understood how the system was built. So after the crash comes the cleanup. But this wasn't about rebuilding what was lost. Oh no, this was about restructuring the entire economy, leading to a massive consolidation of financial and corporate power into fewer and fewer hands. This might be the single most important takeaway from all of this. During a panic, wealth doesn't just vanish into thin air. It changes hands. It flows from the desperate and the people with too much debt to those who prepared, those who have cash ready to go. A crisis is the ultimate filter, separating those who hold real assets from those who are left holding paper promises. And you can see the result right here in the numbers. In 1929, the US had around 25,000 different banks. By 1935, nearly 10,000 of them were just gone. They failed, and their assets were swallowed up by the bigger fish. The crisis didn't spread wealth out. It concentrated it, dramatically, especially in banking. So while the public was lining up at soup kitchens, the great industrialist families went on an absolute shopping spree. The Rockefellers expanded their oil empire. J.P. Morgan consolidated his control over the financial system. Andrew Mellon, who was the Treasury Secretary himself, was publicly calling for liquidation, while his own private companies were buying up assets for cheap. The DuPonts moved into new industries. For them, the Depression wasn't a disaster. It was the sale of a lifetime. But the most unbelievable move was still to come. After all the corporations and banks were consolidated, the government went after the money of the people themselves. In 1933, President Franklin D. Roosevelt signed Executive Order 6102, which made it illegal for private citizens to own gold. It was a direct seizure of the ultimate form of money. And here's how this handoff worked. First, citizens were forced to turn in their gold coins and bullion at the official price of $20.67 an ounce, under the threat of prison time. The government collected it all. Then, just a few months later, after all the private gold was safely tucked away in its vaults, the government just unilaterally changed the price to $35 an ounce. The result of this maneuver? An instant 69% profit for the government on every single ounce it had just taken from its own citizens. It was one of the single largest, most direct wealth transfers from the public to the state in all of American history. They didn't just take the asset, they immediately devalued the paper money they gave you in return. So that's the blueprint from the 1930s. Inflate a bubble, trigger a crash, consolidate the assets, and then seize control of the money itself. So now, let's connect this history to our world today. Is this just a ghost story, or is history rhyming? Let's just compare the playbooks, side by side. In the 30s, the problem was bank failures. The solution offered was gold confiscation and new government programs. The result? Centralized power. Now look at our time. The problem is too big to fail banks. The solution? Bank bailouts and quantitative easing. And the result is exactly the same: greater consolidation and record-breaking national debt. The mechanism hasn't changed at all, only the terminology and the scale. And the modern version of that 69% gold revaluation? It's inflation. It's not a sign of a healthy economy. It's a policy choice. A steady 2% inflation target is a slow, methodical devaluation of your savings. It's a silent tax that continuously transfers wealth from people who save cash to those who own assets that go up with inflation, like stocks and real estate. It achieves the exact same outcome as the 1933 seizure. It just does it much more slowly and quietly. So, the crucial point is this: whether we're talking about the crash of '29, the crisis of 2008, or the pandemic response in 2020, every major shock seems to follow the same script. Weak hands get shaken out of the market, assets are consolidated, and wealth becomes more and more concentrated. The playbook, it seems, is timeless. And that leaves us with one final, unavoidable question. History doesn't just show us that crises happen, it shows they are moments of immense wealth transfer. The game doesn't change, only the players do. The real question is, armed with this knowledge of the past, are you prepared for the next handoff?